Do you know that most people in the market fail just because they rely only on strategies and indicators? The truth is, the biggest secret to winning in the market is hidden in your mind and psychology. In this video, we bring you the full story of the audiobook, The Trader's Mindset. You will learn how anyone can earn consistent profits by controlling emotions, sharpening discipline, and mastering mindset. If you truly want to take your trading to the next level, then you must watch this video till the end. Because every chapter contains those psychology secrets that only top traders know. So let's begin and understand the mental secrets of trading. Chapter 1. Your first market. Testing the mind. Have you ever wondered why two people looking at the same chart, same signals, get completely different results? Why does one trader consistently make profits while another keeps blowing up their account? The truth is, before defeating the market, you must win your first market, and that market is your own mind. Core message of the chapter. Chapter 1 says, the real battle of trading happens inside you. Unless you understand and control your mind's patterns, subconscious impulses, and emotional triggers, no technique or system can make you consistently profitable. What is the first market, and why is it important? The first market refers to your internal challenges, your fear, greed, ego, and subconscious patterns. The market is external, but trading decisions are internal. Understand this first. 1. Your mind always interprets. Any price move is neutral, you give it meaning, and that meaning shapes your actions. 2. Trading is a behavior game. Charts remain the same. What changes is how you read those charts and what emotions influence your reading. 3. Consistent traders don't change charts, they change reactions. 3 common internal patterns that trap every new trader. The author and practical experience reveals 3 inner patterns that cause repeated losses. 1. Reacting, not responding. Reaction equals instant, emotion-driven, rule-less. Response equals planned, rule-based, outcome-neutral. Example, sudden price fall right pointing arrow. Reaction, panic sell. Response, check stop loss right pointing arrow follow plan. 2. Seeking certainty. People want the market to be 100% predictable. This craving leads to over-analysis or paralysis. Truth, the market is probabilistic. Top traders think in probabilities, not certainty. 3. Identity traps. Beliefs like I'm not a good trader or I'm only this type of trader limit decisions. When you lock yourself inside identities, you miss real opportunities. Role of the subconscious. Why trading happens in automatic mode. Your conscious mind can handle few decisions. The subconscious handles the rest. That's the danger in trading. When you experience stress, like a big loss, the subconscious tries to protect you and repeats the same reactive patterns. Example, trauma from a blown account activates fight/flight when risks appear. So you either skip good entries or remove stop losses. Without awareness, any rule system remains theory. It doesn't translate into action. Hammer and wrench practical toolkit, the most important part. Here are powerful steps from Chapter 1 you can start right now. 1. Pre-trade 3-question drill. Ask yourself before every trade, why am I taking this trade? Logic/signal or emotion. If this becomes a loss, is my risk predefined and manageable? Will I stick to my plan even if it hurts? This reduces impulsive reactions and forces conscious decisions. 2. Trade journal emotion log. Along with P&L, note 3 emotional points for each trade. Pre-trade mood, confident/anxious/bored. During trade feeling, fear/hope/greed. Post-trade learning, what was different, why rules broke. Within 30 days, patterns reveal your real weaknesses. 3. Daily 5-minute awareness routine. Spend 5 minutes before market opens. Breathing exercise +1 intent line. Today I will follow rules, max risk X%. This signals the subconscious that you are trading consciously. 4. Define non-negotiables. 3 rules you will never break, such as max risk per trade, fixed stop-loss placement, when to stop trading for the day. These become behavioral anchors. Story. Rahul's eyes opened. Rahul was a technical genius, master of indicators, but results varied. One day he took a huge margin and blew his account. He changed systems repeatedly, but kept losing. When he reviewed his journal, he found his major losses were linked to lack of sleep, stressful phone messages, and recent humiliation. When he fixed his routine and followed the 3-question drill, his results changed. The story shows it wasn't external tweaks but internal adjustment that changed the game. Common objections and exact counter strategies. Objection 1. If I observe emotions, I will miss opportunities. Answer. Observation slows reaction, not execution. You enter calmly and precisely. Objection 2. I read so much yet still fail. Does mindset mean everything? Answer. No. Knowledge is essential, but not enough. Trading needs strategy plus risk management plus mindset. Mindset converts rules into action. Chapter 1. Takeaways. The real battle is internal. Subconscious patterns break rules. 3 traps: reacting, certainty-seeking, identity traps. Simple rituals change behavior. Perform drills for 30 days to see patterns and improvement. Next, we discover the subconscious patterns that destroy trades and a method to reprogram them permanently. Chapter 2. The trader's real enemy, the subconscious mind. Have you ever wondered? You wrote rules. You know where to enter, how much risk to take, where to put SL, yet during real trading, you break rules. Why? Because it's not the market. Your subconscious mind remote controls your decisions. Today's chapter exposes this silent enemy. Main message. Until you recognize your subconscious patterns, the market will defeat you repeatedly, even with a perfect system. Conscious versus subconscious. 1. Conscious mind, 10%. Thinks, makes rules, plans discipline. From tomorrow I'll be disciplined comes from here. 2. Subconscious mind, 90%. Formed by life experiences, drives habits, reactions, fears, fast and impulsive. Problem. Conscious writes rules. Subconscious executes trades. That's why traders repeat the same mistakes. 5 dangerous subconscious patterns. Pattern 1. Pain avoidance. For the brain, loss equals danger. Subconscious avoids the pain by making you remove SL, hold losing trades, book wins quickly. Mission. Avoid emotional pain, not follow logic. Pattern 2. Past trauma replay. Old trading pain repeats itself. Loss in a sector once right pointing arrow, next time subconscious says don't do it even if chart is bullish. Subconscious reacts to fear, not reality. Pattern 3. Ego protection. Ego hates admitting mistakes. Stop loss hits, so it whispers, market will come back. Wait. This waiting becomes destruction. Pattern 4. Reward addiction. Profits right pointing arrow dopamine. Dopamine addiction leads to overtrading, chart refreshing, overconfidence. Subconscious chases dopamine, not logic. Pattern 5. Short-term survival instinct. Brain evolved for instant survival, not long-term probability. Thus traders ignore risk, treat every trade like life or death. Trading is long-term probabilistic. Subconscious is short-term emotional. Signs the subconscious controls you. 1. You knowingly break rules. 2. Body reacts physically, heart race, breath heavy, sweaty palms. 3. Behavior changes after loss, revenge, overtrading, or no trading. These are subconscious defense mechanisms. 5 action steps to control the subconscious. 1. Pause technique. Pause 3 seconds before every action. This interrupts subconscious patterns. 2. Emotion labeling. Name the emotion. This is fear. This is greed. This is ego. Label reduces power by 50%. 3. Pre-trade mental check. Ask, what emotion am I in? System-based or emotion-based decision? 4. Visualization technique. Visualize calm execution, SL respect, steady reaction, even after loss. Subconscious follows that message. 5. Stop trading trigger word. Pick a word like reset. Say it out loud when emotions rise. It breaks patterns instantly. Story. Anjali and the illusion of control. Logical girl, impulsive trader. Her hands executed trades without planning. Journaling revealed childhood control issues. Subconscious craved freedom. Pause plus emotional labeling changed her trading. Subconscious runs decisions from childhood experiences. Chapter 2. Summary. Subconscious controls 90% trades. Trauma, ego, dopamine addictions cause losses. Breaking rules equals subconscious victory. Pause, labeling, visualization equals weapons. Trading psychology equals brain reprogramming. Next chapter reveals how the brain processes loss and forces repetition of bad trades. Chapter 3. The truth of loss. How the brain understands loss. People don't lose because of profits. They lose because of loss reactions. You fight not the market but your brain's loss response system. Loss equals not money. Loss equals danger, shame, failure, existential threat. Loss equals pain. Psychologists note, loss activates the same brain area as physical pain or emotional heartbreak. Thus traders panic, ignore system, revenge trade. It's survival wiring. The brain's loss circuit. 3 stages. Stage 1. Shock. First loss freezes brain. Signs: stare at screen, remove SL, blank mind. Stage 2. Fear. Second loss triggers amygdala. Fear whispers, exit now. Don't open market. Don't enter again. Fear is biological, not logical. Stage 3. Fight. Revenge mode. Get the money back now. That leads to destruction. Loss aversion. Pain of loss equals 2x pain of missing profit. Results. Book wins early. Hold losses longer. Rage on SL hits. Exit winning trades early. This inverted behavior causes failure. Why loss feels like mistake? Because childhood conditioning taught, don't be wrong. Failure equals shame. Thus traders hide losses. Remove SL. Average down. Avoid journaling. This is shame avoidance. 5 techniques to neutralize loss. 1. Treat loss as cost, not mistake. Loss equals business expense. Mistake equals breaking rules. 2. Loss pre-acceptance ritual. Say, loss will come. It's normal. Loss is part of strategy and growth. This removes subconscious resistance. 3. Loss visualization. Visualize SL hit plus calm reaction. Prepares brain for shock. 4. System-based exit. Exit by rule. Right pointing arrow. Loss becomes data, not pain. 5. Loss journaling. Write why loss occurred. Rule followed. Emotion. Journal equals light in dark corners. Story. Rohit's 5 lakh lesson. Revenge trader. Doubling position after SL. Childhood shame created pattern. When he accepted loss as cost, not mistake, turnaround began. Chapter summary. Loss equals physical pain. Brain reacts. Shock right pointing arrow. Fear right pointing arrow. Fight. Loss aversion flips logic. Shame creates revenge. Techniques neutralize emotional pain. Master loss equals master emotions. Next chapter shows how beliefs shape decisions and cause repeated trading errors. Chapter 4. The power of beliefs, the source of your trading decisions. Your trading decisions don't come from strategy or indicators, but from beliefs and subconscious mind. Beliefs equals filters. Market is neutral. Belief decides profit or loss. Bullish belief sees opportunities. Bearish belief sees danger. Positive versus negative beliefs. Positive. Loss is normal. Trading skill grows. System must be followed. Right pointing arrow calm, disciplined, consistent. Negative. Loss equals mistake. Market cheats me. I need luck. Right pointing arrow. Overtrading, revenge, impulse. How beliefs form. Childhood experiences, past trades, environment, media. Belief modification techniques. 1. Identify limiting beliefs. Loss equals mistake. Market is against me. 2. Challenge belief. Look for evidence. 3. Replace belief. Loss equals part of business. 4. Affirm daily. I trust my system. Story. Sneha's belief shift. Fearful swing trader. Journaling revealed limiting beliefs. Replacing them led to consistent results and stable returns. Chapter summary. Beliefs shape decisions. Negative beliefs cause impulsive losses. Positive beliefs create disciplined consistency. Upgrade belief engine before upgrading trading skills. Next chapter preview. How to design a trading system that protects from losses and maximizes profits. Chapter 6. Understanding the market, the role of behavior in trading. Have you ever wondered why market behavior always seems unpredictable? Ari Kiev says, the market is not just numbers, but the result of people's emotions and decisions. Today we will learn how to make profitable decisions by understanding market psychology. Market behavior, what is it? Market behavior refers to the patterns in price movements and trends that are formed by the collective decisions of investors. Traders greed right arrow price spike. Fear right arrow price drop. Herd mentality right arrow trend continuation or reversal. Key. The market is not just technical charts, but a reflection of human psychology. Core concepts of market psychology. 1. Greed and fear. Fear, right arrow panic selling. Greed, right arrow overbuying. Emotional control, right arrow trading system, plus risk management. 2. Herd mentality. Following the trend is easy, but the risk of a reversal is high. Example. Stock bubble right arrow people buy irrationally. 3. Overreaction and underreaction. Extreme reactions to news right arrow short-term volatility. Skillful traders right arrow exploit underreaction for profit. Market analysis and decision-making. Understanding the market means identifying behavioral patterns, trend identification, support and resistance zones, volume analysis for validation, emotional cues from market participants. Tip. You cannot control the market, but you can take advantage by reading its behavior. Real story. Sneha's market reading. Sneha, a swing trader, used to follow only technical indicators right arrow, often went into a loss. When she started learning market psychology, tracked news reactions, assessed market sentiment, made entries and exits psychologically informed, Result: losses decreased, profitable trades increased, confidence in decision-making improved. Chapter summary: market behavior equals collective emotions plus decisions of investors. Impact of greed, fear, herd mentality, overreaction and underreaction. Right arrow trading opportunities. Reading the market is the base of skillful trading. Lesson: trading is not just a game of charts or indicators. Understanding human behavior is the biggest weapon. The next chapter will tell us the impact of psychology and beliefs in trading, how to strengthen your mindset. Chapter 7: the impact of psychology and beliefs in trading. Did you know that your trading decisions don't just depend on market conditions? Ari Kiev says, your personal beliefs and mindset are the biggest factors in your trading results. Today we will learn how to understand your belief system and how to apply it in trading. The role of beliefs and mindset. Trading mindset means your subconscious thoughts, experiences, and beliefs that affect decision-making. Positive beliefs: right arrow confident, disciplined trades. Negative beliefs: right arrow hesitation, overtrading, fear-driven losses. Key: having a strong mindset is just as important as having a strong strategy. Common psychological traps. 1. Fear of loss. Fear of loss, right arrow premature exit. Lesson: learn to accept risk. 2. Overconfidence. Successful trades: right arrow overtrading, ignoring risk. Lesson: consistency greater than ego. 3. Anchoring bias. Overvaluing past experience. Lesson: evaluate every trade independently. 4. Confirmation bias. Only looking at data that confirms belief. Lesson: objective and complete data analysis is necessary. How to modify beliefs. 1. Identify your emotional triggers. 2. Mindfulness and self-reflection. 3. Positive affirmation plus realistic expectations. 4. Maintain a trade journal. Right arrow analyze decision patterns. Result: self-awareness, right arrow disciplined trading, right arrow better outcomes. Real story: Rajiv's mindset transformation. Rajiv, a retail trader, always traded impulsively. Losses were happening repeatedly. Maintained a journal. Right arrow psychological patterns were revealed. Mindset training, right arrow belief modification. Result: now trading decisions are structured, disciplined, and profitable. Chapter summary: trading psychology equals beliefs plus mindset. Common traps: fear, overconfidence, biases. Strengthening the mindset leads to disciplined trading and consistent profits. Self-awareness plus journal plus mindfulness equals key to success. The next chapter will tell us set up and entry techniques within your trading system, how to make strategy practical. Chapter 8: set up and entry techniques within your trading system. Did you know that just having the right strategy is not enough? Ari Kiev says, correctly implementing entry and setup techniques is the real secret to trading success. Today we will learn how to design and apply the right setup and entry techniques within your system. The meaning of setup within the system: every trader has their own trading system. The setup within the system defines when to enter the trade, when to exit. Risk management. Key: system plus disciplined execution greater than market prediction. Types of entry techniques. 1. Technical entry. Charts, indicators, trend lines, moving averages. Example: EMA crossover right arrow entry signal. 2. Pattern-based entry. Price patterns, head and shoulders, double top/bottom. Entry only after confirmation. 3. Breakout entry. Support/resistance levels break right arrow strong signal. Entry with risk management is necessary. 4. Contrarian entry. Trading opposite to market sentiment. High risk, high reward strategy. Risk management integration. Determine stop loss and position sizing with every entry. Risk equals a small percentage of total capital, 1 to 2%. Avoid impulsive entries, right arrow. Maintain system discipline. Tip: strictly following entry rules and risk management is the key to success. Real story: Ankit's entry transformation. Ankit often made impulsive trades. Entry opposite to the trend, right arrow repeated losses. Systematically implemented entry rules, right arrow win rate increased from 60% to 75%. Psychological confidence also improved. Chapter summary: entry techniques equals technical, pattern, breakout, contrarian. System discipline plus stop loss plus position sizing equals risk control. Defining the setup and entry properly reduces losses and increases consistency. The next chapter will tell us how to enter the market and why entry is not that important. Chapter 9: how to enter the market and why entry is not that important. Do you think that just finding the perfect entry point is the biggest advantage in trading? Ari Kiev says that the right time for entry is not as important as it seems. Today we will learn how to enter the market and why obsessing over entry can be detrimental. The meaning of market entry. Market entry equals the point of joining the trade. Many traders make it a life or death situation. Reality. The right entry is helpful, but system discipline and risk management are more important. Limitations of entry. 1. The market is never predictable. No one guarantees a perfect entry. 2. Overanalysis, right arrow paralysis. Continuously searching for the right entry stops profits. 3. Psychological trap. I am missing the perfect entry, right arrow impulsive trades. Alternatives/focus for entry. Focus on risk-reward ratio and position sizing. A little compromise on entry right arrow long-term success. Example. Entry-level PM 1 to 2% flexibility right arrow trade profitable. Stop-loss target properly set right arrow maintain system discipline. Real story. Ravi's entry lesson. Ravi always looked for the perfect entry right arrow constant miss, frustration, losses. Followed Kiev's advice right arrow flexible entry plus system discipline. Result. Losses decreased, confidence increased, long-term profitability grew. Chapter summary. Perfect entry equals ideal, but not critical. Flexible entry plus risk control plus discipline equals winning formula. Entry obsession equals psychological trap. Avoid impulsive thinking. The next chapter will tell us protecting capital with effective stop-loss. Chapter 10. Protecting capital with effective stop-loss. Have you ever lost a trade and thought, I wish I had set a limit to stop earlier? Ari Kiev says that capital protection is the most important rule in trading. Today we will learn how to set an effective stop-loss and why it is your biggest trading weapon. The importance of stop-loss. Stop-loss equals a predefined price level where the trade will automatically exit. Purpose. Preventing big loss. Avoiding emotional decisions. Long-term capital preservation. How to determine stop-loss. 1. Based on technical analysis. Support/resistance, moving averages. 2. Percentage method. 1 to 3% loss tolerance of capital per trade. 3. Volatility method. Stop distance based on ATR, average true range. Common mistakes. 1. Forgetting to set a stop-loss right arrow big loss. 2. Emotional stop adjustment right arrow system breakdown. 3. Too tight stop right arrow frequent exits, missing profits. Real example. Neha's stop-loss lesson. Neha used to trade without a stop-loss right arrow big losses. Followed Kiev's advice right arrow preset stop-loss plus discipline. Result. Capital protected. Confidence increased. Consistent performance. Chapter summary. Stop-loss equals core of capital preservation. Predefine and stick to it right arrow. Avoid emotional mistakes. Flexible adjustments, but discipline equals key. The next chapter will tell us profit-taking strategies and exiting the trade in the best way. Chapter 11. Profit-taking strategies and exiting the trade in the best way. Have you ever lost a trade that was going in the right direction but you didn't exit on time? Ari Kiev says that learning profit-taking strategies and disciplined exiting from a trade is the real secret to winning in trading. Why profit-taking is necessary. Taking profit equals capital growth plus risk management. Overstaying a trade equals emotional mistakes plus losses. Kiev's philosophy. Take what you need, then get out. Key strategies. 1. Target-based exit. Predefined price target right arrow risk/reward ratio 2 to 1 or 3 to 1. 2. Trailing stop. When the market is favorable, right arrow gradually adjust the stop loss. 3. Partial exit. Exit a part of the position right arrow reduce risk plus lock gains. Emotional control. Avoid greed when the trade is growing. Do not exit due to panic when the trade is falling. Kiev's advice. Discipline equals profit maximizer. Real example. Rohit's trade exit. Rohit set a 2 to 1 risk/reward target. The market went up by 5% more right arrow followed trailing stop right arrow locked profit. Outcome. Disciplined exit plus long-term confidence. Chapter summary. Profit-taking equals the second core rule of trading. Predefined targets plus trailing stops plus partial exit equals best strategy. Discipline plus psychology equals sustainable profits. The next chapter will tell us the importance of psychology and belief within the trading system. Chapter 12. The importance of psychology and belief within the trading system. Have you ever thought that one trader uses the same system but wins consistently and another keeps losing? Ari Kiev says that the real reason is mental belief and mental alignment with the trading system. Connection between system and mindset. 50% of any successful trading system is strategy, 50% is psychology. Even if the system is correct, if there is no belief, right arrow hesitation, over-trading, losses. Kiev says, psychological alignment is what brings consistent profit. Core beliefs of successful traders. 1. Market neutrality. You cannot control the market. Right arrow, accept reality. 2. Loss is part of the game. Not every trade is profitable. Right arrow, emotional acceptance is necessary. 3. Discipline over impulse. Rule-based approach. Right arrow, impulsive decisions equals biggest enemy. Belief alignment steps. Create a psychological checklist before a trade. Note emotions during the trade. System plus personal belief equals confidence. Right arrow, better execution. Real example. Ankit's trading confidence. Ankit adopted a new system. Right arrow, losses in the beginning. Followed Kiev's advice. Maintained belief plus discipline. Result. Consistent gains plus emotional stability. Chapter summary. Psychology in trading equals as important as the system. Core beliefs. Market neutrality. Loss acceptance. Disciplined approach. System plus belief equals sustainable profitability. The next chapter will tell us how the real fear and greed of the market affect your trading. Chapter 13. How the fear and greed of the market affect your trading. Have you ever felt sudden fear or greed while trading, and did it affect your decision? Ari Kiev says that these are the two biggest psychological forces that keep traders away from consistent profit. The effect of fear. Fear often turns into overreaction and premature exits. Traders think, what if I lose more? Result. Giving up a potentially profitable trade. Kiev says, learn to face fear, only then will you become rational. The effect of greed. Greed often shows up in holding positions or over-leveraging. The trader thinks, if I wait longer, I will make more money. Result. Even a small profit can turn into a loss. Key. Sticking to the system's rules. Steps to control fear and greed. 1. Emotion tracking. Write down for every trade. Did I feel fear or greed? 2. Predefined rules. Determine stop loss and profit targets. 3. Mental rehearsal. Practice scenarios before the trade. Right arrow, build confidence. 4. Acceptance mindset. Loss is inevitable. Right arrow, emotional detachment. Real example. Rahul's story of greed and fear. Rahul started a trade. Right arrow, first loss. Right arrow, panic sell. In the next trade, greed. Right arrow held the position longer. Applied Kiev's technique. Right arrow rules plus emotion tracking. Result. Controlled, profitable trading. Chapter summary. Fear equals premature exit. Greed equals overholding. Both fear and greed block rational decision-making. Emotion tracking plus rules plus mental rehearsal equals effective control. The next chapter will tell us how to build consistency, how to gain a psychological edge in trading. Chapter 14. Building consistency, how to gain a psychological edge in trading. Do you know that the biggest problem for most traders is consistency? Ari Kiev says winning in the market is not a one-time game, but a game of consistently right mental approach. Why consistency is difficult. Every trade is different. Right arrow, unpredictable market. Emotional reactions. Right arrow, fear and greed. Past mistakes. Right arrow, confidence drop. Key. Having a long-term perspective. Steps to build a psychological edge. 1. Establish a daily routine. Review before the market opens. Maintain a trade journal. 2. Rule-based trading. Stop loss, position sizing, entry and exit rules. 3. Self-awareness and emotional check. Assess mental state before every trade. 4. Continuous learning. See mistakes as learning opportunities. Case study. Suresh's journey. Initially inconsistent. Right arrow, fear plus greed. Adopted a rule-based approach. Right arrow, emotional detachment. Outcome. Consistent profits over months. Chapter summary. Psychological edge equals self-awareness plus rules plus practice. Consistency is the biggest advantage in trading. Emotion control plus predefined system. Right arrow, long-term profitability. Chapter 15. Trade evaluation and learning from mistakes. It is essential to evaluate every trade. There are things to learn in both winning and losing. Maintain a trade journal. Right arrow, identify patterns and mistakes. Lesson. Continuous self-reflection improves performance. Chapter 16. High-pressure trading and mental resilience. Emotional control is crucial in a high-pressure environment. A focused mindset and breathing techniques help. Lesson. Follow the system even under stress. Avoid impulsive decisions. Chapter 17. Market cycles and emotional adaptation. The market always fluctuates. Right arrow, bullish and bearish phases. Emotional adaptation. Right arrow, managing greed and fear. Lesson. Adjust your expectations according to the market mood. Chapter 18. Risk perception and reward management. Learn to perceive risk correctly. Always define the reward-to-risk ratio. Avoid over-leverage and impulsive positions. Lesson. Risk control equals long-term survival plus profitability. Chapter 19. Trade journaling and reflective practice. Trade journal equals a personal feedback tool. Note mistakes, emotions, market observations. Lesson: writing plus reflection, right arrow, builds a psychological edge. Chapter 20. Stress management and burnout prevention. Stress and burnout are common in trading. Take breaks, pursue hobbies, focus on sleep and nutrition. Lesson: healthy mind, right arrow, discipline, trading, right arrow, long-term success. Chapter 21. Mastery mindset. Emotional intelligence plus discipline. The final chapter highlights mastery mindset. Emotional intelligence plus discipline, right arrow, makes a profitable trader. Self-awareness, consistency, and learning, right arrow, trading mastery. Lesson: the secret to winning the market is not just strategy, but mindset. Friends, the trader's mindset teaches us a very deep truth. Before you conquer the market, you have to conquer your own mind. If you have watched this video till here, it means that you don't just want to learn trading, you want to become the right trader. The trader who makes decisions with clarity and discipline, not emotion. Remember, the right system shows you the way, but the right mindset gives you the strength to keep walking. If this summary has changed your thinking, or brought even a little clarity to your trading journey, then like the video, subscribe to the channel, and comment which chapter affected you the most. We will meet in the next video with another life-changing book summary. Until then, stay calm, stay disciplined, and trade smartly.